Good morning, restaurant owners. Welcome back to our weekly training. I'm Tim Cernett, CPA. I'm the founder of Financial Optics, where we help independent restaurant owners improve profits and cash flow with financial insight, financial clarity, and strategic foresight. This weekly training is designed to help you use your accounting systems to make better financial decisions and with that, hopefully become better operators. Now, last week we built your operating plan, the restaurant's financial GPS. Today, we're tackling something that confuses a lot of restaurant owners, confuses a lot of business owners, and honestly, for good reason, because parts of it are genuinely complex. We're talking about cash flow. Now, let me share my screen and we'll get to this presentation. Share. Okay. So here's what I see a lot, and a lot of business owners express this sentiment. The P&L says I'm making money, the restaurant is busy, but when I look at my bank account, it doesn't reflect what my financial statements are telling me I'm making in profit. Where is the cash going? If that sounds familiar, you're not alone. You're not imagining things. Cash shortages is also where a lot of businesses actually die. And research puts poor cash flow management behind the large majority of failures. Not poor food, not poor service, not even poor sales. Poor cash flow management. And restaurants with their thin margins and complex financial dynamics are more vulnerable to this than almost any other type of business. So let me start with the most important concept in today's training. Profit and cash flow, they're not the same thing. They're related. There's no positive cash flow without adequate profit levels, but they don't move in lockstep. You can be profitable on paper and still run out of cash. And running out of cash isn't bad luck. What we're going to show today is that it's bad planning. The good news is if you plan properly, you can anticipate cash needs and make the moves you need to make to cover it. Okay. The reason profit and cash flow diverge starts with a deliberate accounting choice, accrual basis reporting. Now, we use accrual intentionally because it gives us an accurate profitability measurement. Accrual basis is the only way to analyze the success of your restaurant, but because of accrual, understanding cash flow requires looking beyond the P&L. You have to look at the balance sheet. And if you remember from week 6 training on financial system breakdowns, this is one of the 7 gaps we identified. Cash basis accounting. It's simple. Record revenue when cash comes in and expenses when the cash goes out. And it's how most of us think about our personal finances. Money in, money out, what's left. However, that doesn't really work in business. Accrual accounting records revenue when it's earned, and it records the expenses when they're incurred, regardless of when the cash actually changes hands. And we use accrual intentionally with our clients, always have and always will, because it gives us accurate measurements of profitability and margins and gives us insight into how the business is performing. So here's a simple example. You receive a big food delivery on the last day of April. Could be any month, but April's the example here. But you don't pay for that invoice until mid-May. On the cash basis, April looks great because that food delivery doesn't show up. May looks terrible because it's carrying April's food cost plus its own. Neither month gives you an accurate picture. The accrual basis is recording these transactions when the event actually occurred, when the exchange of the inventory actually happened, instead of when it's paid for. So I hope that concept makes sense. We use the accounts payable liability account to record the transaction. At the time the product is received or the expenses incurred, we record it in the P&L and we also record the offsetting liability. And when the cash is paid, the offsetting liability accounts payable balance is lowered and the cash goes out. On the accrual basis, that food inventory increase, remember our proper food cost calculation is based on the usage. So on the accrual basis, that inventory increase belongs in April because that's when it was actually received. And April's food cost is accurate. May's food cost becomes accurate. Your margins are real. Your P&L is telling you the truth on how your restaurant actually performed that month. So accrual is far better for measuring profitability and performance, and it's when your financial statements should be based on. But here's the trade-off. Because accrual matches expenses to the period they belong in when they are actually incurred, rather than when the cash moves, your P&L profit doesn't directly equal the cash change in your bank account. That's the confusing part. And this is the key insight here. Because we intentionally use accrual to have accurate profitability measurements and insights, understanding your actual cash position and cash movements requires looking at the balance sheet, not just your income statement. Your P&L tells you whether you're generating a profit when it's on the accrual basis. Your balance sheet tells you whether that profit is turning into cash or getting consumed by other things like debt payments, inventory buildup, and other timing differences that we're going to explore here today. Most restaurant owners, most business owners live in their P&L and never look at their balance sheet. If you're wondering where the cash is going, the balance sheet is where that answer lives. Okay, so balance sheet awareness, that shows you your cash position, your obligations, and your full financial picture. I know the balance sheet feels a little bit intimidating to a lot of restaurant owners, but you don't need to become an expert. What the balance sheet shows is your assets, what you own, cash in the bank, inventory on the shelves, equipment, that catering van, those are all assets and show up on your balance sheet as an asset. It's also where your cash position lives, your cash in bank, your savings account, and any other liquid assets that actually are considered cash. That's a number on the balance sheet, not your P&L. The liabilities portion of your balance sheet is what you owe. Vendor payables, accounts payable, credit card balances, loan balances, payroll taxes due, income taxes due. These are your cash obligations. And when they're growing faster than your cash, that's a warning sign. Equity is the difference. Your net worth in the business, assets minus liabilities equals equity. We're not going to spend a lot of time on that. Now, let's make this a bit easier. Here are the three numbers I want you to be looking at every month alongside your P&L and your operating plan. We talked about last week, you're always comparing actual to plan when you're looking at your P&L. So number one is your cash position, and that lives on the balance sheet assets, your cash accounts, your bank accounts, your savings accounts. Is that number growing or declining month over month? If it's declining while your P&L shows a profit, something else is consuming cash that isn't showing up as an expense. Your debt, principal payments, inventory buildup, equipment purchases, we've already mentioned those. Those will show up on the balance sheet and it will tell you what's consuming cash. Your total debt, and that's on your balance sheet liabilities. Is the total debt growing or shrinking? Every dollar of debt service is a dollar of cash that doesn't show up on your P&L, and it eats your reserves and doesn't go into your pocket. And here's the part that trips a lot of people up. The principal portion of the loan payments reduces cash, but isn't an expense on the P&L. Only the interest portion is the expense on the P&L. So your P&L can look fine while debt is quietly draining your cash position. Now, the third number is a section of your total liabilities called accounts payable, and we want to look at that in the accounts payable aging format. Which of your vendor payables are current, 30 days past due, maybe 60 days past due, hopefully not 90 days past due, but you want to have that aging report in front of you every week to analyze it. So are you staying current with your vendors? Are you stretching payments out and sometimes even past the due dates? Stretching payables is often the first symptoms of cash flow pressure, and it erodes vendor relationships and trust. So those three numbers, cash position, total debt, and your accounts payable aging, together with your P&L gives you a more complete financial picture. Your accountant can help you go deeper, and we do go much deeper than this with our clients, but at a minimum, as the owner, you should be looking at these numbers every month. Okay, let's talk about your cash reserve. Here's a principle that sounds obvious, but most restaurant owners don't follow it. Your restaurant needs a cash reserve. The restaurant business is inherently unpredictable, seasonal swings, equipment failures, supply chain disruptions, a snowstorm slow week that you didn't expect, a key employee leaving at the worst possible time. I don't mean to depress you, but the restaurant business is unpredictable, and without cash reserves, every one of those moments can become a cash crisis. With reserves, they're manageable situations you can handle without panic. Financial experts typically recommend, and I'm one of them, 3 to 6 months of operating expenses as a target. Now, if you're not there today, don't let that number paralyze you. Build toward it. Start by setting aside a consistent percentage of revenue every month that you're not going to spend and continues to build reserves, maybe 2 to 3% going to a separate reserve account. Get it out of your operating cash account. Doing that is better than nothing. This connects directly to the operating plan we built last week. If you know your slow season is January through March, you should be building reserves during your peak months, specifically to fund operations during the slow period. Your slow season is not a surprise, it's a planning exercise. And it's one of the most important things your operating plan does for cash flow. And here's the key concept. Your 12-month operating plan shouldn't just be a P&L budget exercise. It should include a projected balance sheet as well, so you can see cash positions change month over month. When you project out the balance sheet, you see your total debt reductions, your accounts payable ebbs and flows across 12 months, and you can actually visualize your cash position throughout the year. That's how you answer those three questions that keep you awake at night. How much cash am I going to need? When am I going to need it? And where's it going to come from? Your slow season cash dip isn't a surprise anymore. And when you see the need coming, you can plan for it appropriately through reserves you've built during peak months, through a line of credit you've arranged for in advance when business is strong, or through financing decisions you've made strategically throughout the year, not in a panic. We'll cover how to see the need coming by projecting out the balance sheet in a bit. Let's talk about debt. Strategic versus destructive debt. Not all debt is bad, but the distinctions matters for cash flow. Every dollar of debt service is a dollar that leaves your business. And the principal portion doesn't even show up as an expense in your P&L. We've already talked about that. Strategic debt funds things that generate a return, equipment that improves productivity, a renovation that increases capacity and expansion when the numbers support it. That's a whole nother topic, when the numbers support expansion. And it must be funded with the right kind of debt. Destructive debt is emergency debt incurred that cover operational holes. Credit cards at 18 to 24% interest or more for everyday expenses. Merchant cash advances, the worst. Borrowing to make payroll. The question to ask is the debt funding something that will build value, or is it plugging a gap? If it's plugging a gap, the gap is the real problem, and more debt won't fix it. Now, we'll cover debt evaluation, debt structuring, and strategic financing in detail in week 10. For today, just be aware that every dollar debt service is a dollar of cash that leaves your business. And the principal portion doesn't even show up on the P&L. I'm beating that to death, which is another reason your income statement can look healthy while your balance sheet, while your cash position tells a different story. All right, cash flow planning. When you build your operating plan like we did last week, and we mentioned this last week as well, you're projecting revenue expense month over month, but you also need to work on the financial operating plan that projects out your balance sheet. And we do that with our clients. We project out the whole set of financial statements, which includes the balance sheet. With that monthly projected balance sheet, you see events like a lump sum loan payment, when my quarterly or semi-annually insurance payments are due, when does my quarterly tax payment land, and when do I expect my seasonal revenue dip? And do I have enough cash built up to sustain operations through those cash flow dips? You see, when done correctly, the projected balance sheet accounts for lower seasonal profits and allows you to plan for cash reserves to cover those seasonal dips. You're getting a higher level picture to answer the three questions. How much cash am I going to need? When will I need it? And where is it going to come from? You'll be planning how to fund slow months with reserves. Do I need a line of credit as a bridge? Are there financing decisions you need to make ahead of time rather than in the moment of panic? And we'll talk about all those financing options in week 10. So, for most restaurants with adequate near-term reserves, incorporating cash flow projections into a 12-month operating plan is the right approach. However, there's another tool, the 13-week cash flow forecast, which can also be deployed as a tactical tool for situations when cash is under immediate pressure and you're feeling that pressure every week. And if your restaurant is experiencing that type of cash flow pressure, if you're regularly scrambling to cover payroll or stretching vendor payments beyond due dates, then you might need this more granular tool, the 13-week rolling cash flow forecast. The 13-week forecast projects out your cash inflows and outflows week by week for roughly a quarter ahead. It shows you exactly when the pressure points are coming. Maybe week 6 has payroll plus a quarterly insurance premium plus a large food order payment is due, all in the same week. You can see that collision coming and plan for it. It's a more involved process. It needs to get updated weekly or sometimes more often than weekly. And I'd recommend building that 13-week cash flow projection with the help of your accountant for the first time you do it. But if cash is an immediate and critical concern, in your restaurant, it's an essential tool. All right, bringing this all together, cash flow mastery comes down to understanding the few key things. Profit and cash flow are related, but not the same. We use accrual accounting intentionally to measure profitability accurately, and because of that, understanding cash flow means looking at your balance sheet, not just your P&L. Your balance sheet holds the answers to your cash flow. Watch those three numbers every month: your cash position, your total debt, and your accounts payable aging. Build cash reserves intentionally. Make a line item on your operating plan. Build it during peak season to sustain you through the slow season. And then integrating your cash flow projections into your 12-month operating plan. Identify the major cash events and seasonal patterns across the year. If cash flow is under immediate pressure, you might need to escalate to the 13-week rolling cash flow forecast. Now, as you can see, cash flow management can be complex. Deeper work, building cash flow projections, analyzing your balance sheet, structuring debt appropriately. This all benefits from professional support. A good CPA or accountant who understands the restaurant business can help you see the full picture and make better decisions. Remember, running out of cash isn't bad luck, it's bad planning. And planning is something that you can do with the right tools and the right support. Okay, everything we've talked about today, accrual accounting, balance sheet visibility, cash flow projections, it all depends on financial systems that are set up correctly. If your accounting isn't on an accrual basis, your profitability picture is distorted. If your chart of accounts doesn't give you the details you need, you can't see where cash is going. If your systems aren't integrated, the data arrives too late to act on. Restaurant Financial Systems Scorecard evaluates all of that. It's a free self-assessment that walks you through your financial infrastructure and shows you where the foundation is solid and where the gaps might be creating the kind of cash flow blindness we've talked about today. I'll drop a link in the comments below this video. take the scorecard, see where you stand. It takes about 10 minutes, and it might be the most valuable 10 minutes you spend this week. Some of you would rather talk through this than fill out a quiz, and I get that. There's a second link in the comments below called Request a Call. In 15 minutes, we can see whether what we do fits what your restaurant needs. Now, next week, we're looking at the technology side of financial management. How to streamline your restaurant's financial system so data flows automatically, reports arrive when you need them, and you're not spending hours on manual processes that technology should be handling. Thanks for joining me this morning. Cash flow is one of those topics that can feel overwhelming, and honestly, it should be a conversation you're having regularly with a qualified accountant who understands your business. I'm going to say that again. Cash flow should be a conversation you're having with your accountant regularly who understands your business intimately. But the principles are straightforward. See the full picture, plan ahead, make sure your profit is actually turning into cash in your bank account. Have a great week, everybody, and we will see you next week.